Okay, can you hear me? Good. I was excited when Richard contacted me and asked if I'd like to come over and do this. First, I had to make sure that this was the Bitcoin Wednesday and not Bitcoin Cash Wednesday, because that's a smaller group. Has nobody made that joke before? So, as Rick was saying, I've been studying money for many years. I'm not quite as old as I look, but still about 35 years. And specifically, private models of money. Money as it was in the days of the gold standard, the days of private note issue, before central banks came on the scene, before money was divorced from its commodity backing and turned into fiat. And it used to be that I only heard the term fiat money when I was talking to gold bugs. So it's a pleasure to hear at cryptocurrency conferences people using the proper technical term to describe unbacked money that's established by decree. But what do we call Bitcoin? Because it's not established by a decree, by a fiat in the literal sense, and yet it is a non-commodity money. And that's what makes it so interesting to me. That's what makes it so surprising. I was telling Rick earlier that I wrote a paper in the 80s predicting that there could not be something like Bitcoin. So I'm still learning, and I welcome interruption at any time for correction or clarification. And I hope to learn something from you who have probably been following some aspects of this market more closely than I have. So we're going to have fun since I brought a PDF instead of a proper PowerPoint file. So I said I've been studying this for a long time. 1984, my free banking in Britain was my doctoral dissertation research, which was free banking meaning a system where there's competition in the issue of currency. And so that was published in 1984, and since then there have been several events that have made me hopeful that my research might actually be relevant to something happening in the world today. There was DigiCash, which didn't really get very far. There was the Mondex card, which was going to be an electronic version of a banknote on a smart chip card. That didn't get very far. But Bitcoin and the whole cryptocurrency asset class has gotten pretty far, I think. I think it's being taken seriously by people on Wall Street, and the way they've responded is kind of a reminder of the old saying attributed to Gandhi. I don't know whether he said it, but first they laugh at you, then they criticize you, and then you win. So we've seen Jamie Dimon, the head of JP Morgan Chase, saying Bitcoin is a fraud, and then the next week we learn that he's got a research group trying to figure out how JP Morgan Chase can create its own proprietary blockchain. In the 90s, I was conversing with some of the cypherpunks, some of the people working on early versions of cryptocurrency, Hal Finney and Nick Szabo. And I was trying to explain to them why it was unlikely that anybody would want this cryptocurrency as an ordinary, everyday medium of exchange. And there are still some obstacles to widespread acceptance as a commonly accepted medium of exchange, right? And I'll come to that later, but I'm less skeptical than I used to be, I guess you could say. No, I'm thinking of digital. but I'm thinking of spending Bitcoin to buy Starbucks coffee, right? And we've seen with the congestion of the Bitcoin blockchain and the transaction fees that there's a problem in trying to do it at the retail level. And we can talk about whether there are ways to overcome that problem. But a couple of years ago, I tried to sort of set forth my thoughts on the market for cryptocurrencies. And every time I give a talk, I go to CoinMarketCap to see what's in the top 10 cryptocurrencies, and every time it's different. So it's a market that is a challenge to keep on top of, as I'm sure you know. Richard asked me to say a little about where I'm coming from. And where I'm coming from is sometimes called the Austrian School of Economics, but in the monetary area in particular, it's the writings of Carl Menger, who gave the first satisfactory account of how money emerged through market forces out of barter. And there's an ongoing debate between the Mengerians today and the opponents who believe that money was created by states, sometimes called the state theory of money, associated with the German economist Knapp, sometimes called chartalism. That debate is going on today, but I think Menger had the stronger case that we can understand money as a market phenomenon and banking as a market phenomenon. And it's certainly hard to account for the value of Bitcoin by saying it has the imprimatur of the state behind it. It has no such thing. And in fact, it's being challenged by state authorities and thriving nonetheless. Ludwig von Mises was a later economist who wrote a book called The Theory of Money and Credit, published in 1912, advancing Menger's ideas a little farther and talking about the way a system of competitive money issue on a gold standard works. And his most important student was Friedrich Hayek. And Hayek was a fairly conventional economist when it came to thinking about money. He was kind of had mixed feelings about the gold standard in the interwar period. That's when he published most of his work in the 1930s and 40s, the work for which he got a Nobel Prize in the 1970s. But after he got the Nobel Prize, and he hadn't written about money in a couple of decades because he was so far out of the Keynesian mainstream. When he got the Nobel Prize, he discovered that people were paying attention to him again. He said, okay, well, here's what I really want to say. We're living in a period of double-digit inflation. He was living in Great Britain for many years, and Britain had more than 20% inflation. Why is our money so terrible? He asked. It's terrible because it's a state monopoly, and there's no penalty to the provider of money for doing a lousy job. They can inflate at 20%, which is like taxing holdings of money by 20% a year, and where can their customers go? They don't allow any competition. People are stuck with that money. So he made a simple proposal. He said governments should not place obstacles in the way of their citizens using currencies from other countries that haven't been so inflationary. So the Swiss franc could be, if it were allowed, used in Great Britain, and that would put pressure on the Bank of England not to inflate so much. That was his original proposal in a pamphlet called Choice in Currency, and he thought about it a little more and said, why don't we let private enterprise into the competition? And here's what he predicted they would do. They would provide currency that promised a stable purchasing power. So that was his prediction, and he said it doesn't have to be linked to gold or silver. We can have private, irredeemable money that the issuers manage the quantity appropriately so as to maintain its purchasing power. So he's thinking about a market for privately issued, irredeemable, that is, it's not converted into gold or silver, currency. And that's where I picked up interest in the idea and started looking into the history of privately issued money, which was a different model, which was a gold and silver redeemable model. But the remarkable thing about Bitcoin and its followers, its competitors, its imitators, is that it is a private irredeemable currency, and yet it looks nothing like what Hayek predicted. So it is private, it is irredeemable, it's not like gold banknotes, it's not like gold coins. Although people sometimes compare Bitcoin to gold, it's supplied through a very different mechanism. Although the term mining is used to describe the processing of payments in the Bitcoin system, the analogy only goes so far. In a gold standard, if the purchasing power goes up, more gold would be dug out of the earth. The rate at which the supply of money expands will increase. And that'll help bring the purchasing power back down to the cost of production. Whereas in Bitcoin, changes in the market value of Bitcoin have no effect on how rapidly the supply grows, because that's in the program. That's already determined, regardless of what the price does. It's a not-for-profit project, right? It was originally, you might say, it was a hobby of the people who launched it. Satoshi Nakamoto, and I'll say a little about who I think Satoshi Nakamoto is. But it wasn't a corporation. It wasn't set up in a proprietary way. It was, here's the source code. Use it. Ripple, by contrast, which is currently number 2, is a for-profit project. Ripple Labs is a private corporation. All the coins are pre-mined, but they're not all in circulation because the people who launched it hold the majority of them. And their problem is, how do we release them at a rate that doesn't depress the value but allows us to start diversifying our wealth? And they're pretty wealthy right now. Is it money? Well, it's an asset, and that's the first step, and that's surprising enough. It is a medium of exchange. People do buy goods and services with Bitcoin occasionally, but the standard definition of what makes something a money is that it's a commonly accepted medium of exchange. And only in a small circle is Bitcoin a commonly accepted medium of exchange. I used to say that I'd never met anybody whose salary was paid in Bitcoin until I met somebody from the Bitcoin Foundation. But even then, the salary was denominated in dollars and then paid in the Bitcoin equivalent, because otherwise the salaries would be astronomical at the Bitcoin Foundation. And as I said, it's issued at a pre-programmed rate. By contrast to a gold standard and by contrast to a fiat standard, there is absolutely no commitment on the part of central banks about how much to issue. There is a weak commitment to try to keep the inflation rate at a certain target. But it's not like it's written into a program, and most central banks could change their target tomorrow if they wanted to. In some cases, it's imposed by law, but the legislature could change it tomorrow if they wanted to. So here's the history lesson. You could think of the earliest currency 1.0 as precious metal coins, and they could either be issued by the state or by the church or by private mints. It's a long history of private gold and silver mints The gold coins at the bottom were issued in North Carolina, in the United States, where there was gold discovered in the 1820s. And for local color, here's the famous painting of the money changer and his wife. Well, one version of it. There are several versions. Okay, he's Flemish, not Dutch, but close enough. And what we see the money changer doing is weighing coins, because he's going to give somebody credit in his books according to how much pure silver is in the coin. That had to be tested. It took weighing and assaying by the money changer. It took a lot of expertise when the coins were debased, as they typically were, because coins were local government monopolies. And so they could force people to use their coins even when the quality went down. So that was a long-standing problem with metallic money. I edited a 3-volume set called The History of Gold and Silver. Should have been Gold and Silver Standards, but blame the publisher. And the whole first volume is about the problem of coins that are debased by the issuer or lightened deliberately by sharp operators, shaving off some of the gold or sweating the coins. So that was a serious problem, but banks came to the rescue. So businessmen wanted to be able to transact without being hassled by the quality of the currency. Bankers said, look, bring your coins to us. We'll test their pure silver content, we'll weigh them, and then we'll give you credit in our books for the amount of silver, not for how many ducats or florins or whatever the name of the coin is, guilders, but we'll actually give you credit for the amount of silver, and then you can transact with other businessmen in silver units, not in a unit where nobody knows what it's worth. And the IOUs issued by these bankers in the form of deposit credits and later in the form of banknotes became the most popular kind of money. It was more portable than gold and silver coins, but more importantly, it was more uniform in its gold and silver content. So there's an early banknote from London Goldsmith Bank. The Bank of Amsterdam is Bank of Amsterdam, New York, but only one I could find. Uh-oh. Help. I know I'm running out of power because I have jet lag, but I didn't think the computer would. This one I like because it makes it clear what the contract is. It says redeemable in gold coin. Right? So there's no question that this is a claim to not just dollars, however defined, but gold coins. But governments got into this business and eventually monopolized it. Here is a local example. Right? So this is redeemable in silver. But once governments have monopolized the currency, where's my page down? They can decide to stop redeeming, and now it's the only game in town. So this is not literally what it says on the back of a US note anymore, but it gets the message across. And since it no longer has a value in gold or silver, what gives it any positive value? You can't get something useful for it. Why do people demand it? The typical explanation is that you can pay old debts in it, that's legal tender. You can pay your taxes in it. A student of mine and I studied the case of Somalia, though, which shows that these aren't really necessary conditions. In Somalia, the government disappeared, just became a stateless system with warring warlords, none of whom ruled the entire country. And yet the currency, the Somali shilling, issued by the previous central bank, for good measure, the central bank was looted and burned to the ground. the Somali shilling continued to circulate. Why? Because why would you stop accepting it? As long as other people will accept it from you, you'll accept it from them. So the necessity of state support for currency, that's what this whole history is telling us, is much less than people imagined. There's nothing mysterious about privately issued currency assets. But here's how the text on the face of Federal Reserve notes, the US fiat money, actually changed. Where it used to say redeemable in lawful money, they just took that out and said this is legal tender for all debts. But here's my favorite, where it used to say will pay to the bearer on demand, $100. That was replaced by ribbon, $100. So it's $100 by decree, or in Latin, by fiat. Right? Back when God spoke Latin, and he wanted to say, let there be light, he said, fiat lux, just let it be. So that's currency 3.0. 4.0 is private IOU nothings, private digital currency. So Bitcoin solved the double spending problem. When you get Bitcoin, you know you're actually getting it and not something that belongs to somebody else at the same time. But that doesn't explain why it has positive value. But the answer is pretty simple. It's supply and demand. There's a limited supply, and there's a certain real demand for it. And the demand has been growing, and therefore the price has been going up. So I wince when I see famous economists like Joe Stiglitz or Paul Krugman saying there's nothing to it, it's all a big bubble. There's really no reason to say that. I mean, our first presumption when we see something valued at $300 billion is that there's something there. Now, there have been cryptocurrencies, I'll show you some pictures, that have had their demand disappear. But they were, Me Too coins. They didn't really do anything different. Bitcoin, of course, has its own unique blockchain, and that's where the action is. It's much bigger than any of the others. It has now a large infrastructure built around it. Coinbase, BitPay, CoinKite, all kinds of firms that make it easy for merchants to accept and make it easy for people to buy and sell. So I'm sure you know all this, but it's not a debt. It's not even issued by a business enterprise, Bitcoin. It's irredeemable, and yet it has a positive value. Now, there's kind of a mystery here in that when gold and silver started being used as currency, they already had a value. In a barter economy, people value gold and silver for use as jewelry, mostly. And that was true of other commodity monies like shells. People used them as jewelry. Bitcoin didn't have any jewelry value. So it's a little bit of a mystery of how it achieved a positive value kind of by its own bootstraps. But part of the answer, I think, is that it comes combined with a payment system. If you want to use Bitcoin if you want to use the Bitcoin payment system, and there are good reasons to want to do that for certain kinds of transactions, then you need to buy Bitcoin. So that explains why people buy Bitcoin and put a positive value on it. I mentioned the Austrian School of Economists, and one of the ideas associated with Ludwig von Mises, who I mentioned earlier, is a proposition called the Regression Theorem. And Mises, sort of summarizing history, said, when new monies are introduced, people have to figure out what value to put on them. In the case of gold and silver, it was easy. They had a value before they became money. They had a commodity value. When bankers introduce claims to gold and silver to circulate as money, people test whether the bankers really will redeem. And if they will, and people trust them, then they acquire a value based on the commodity you can get for it. So a banknote that's good for 1 ounce of gold will have the same value as 1 ounce of gold. How about fiat money? Well, all the fiat monies introduced by governments were first introduced as claims to gold or silver, and then later the option to redeem was taken away, and they continued to circulate because they had a history of being valued, and they had the prospect of continuing to be valued, like the Somali shilling, but even more so when the government continues to exist and backstops the system by making it legal tender and by accepting it in taxes. But Bitcoin didn't have any history like that. So how did it achieve a positive value without a history? Became a big debate among people in this school of thought. And I think the answer is what I already said, that people recognized value in using the Bitcoin payment system, and therefore they needed to acquire the coin. But another way to say that is some of the people who bought Bitcoin early on, before there was any clear business case for it, before it was clear how it was going to be used, this is back when it was worth less than $1, just liked what it stood for. So I actually dug through Reddit in these early discussions until I found somebody saying this explicitly. I'm going to buy so many dollars worth because I like what it stands for, and I'm just going to hold on to it to make a statement. Well, that gave it an initial value. It was pretty low because there weren't that many people who knew about it, let alone were willing to make that statement at that price. But that was enough to get it from zero to something positive, and then it took off from there. So once it has a positive value and it's easy to transact with, it's a potential currency. Now, it's not yet a commonly accepted medium of exchange, but it is a medium of exchange, and it clearly is an asset. So you may know already about the history of Bitcoin, but as I say, it was launched, we're not even sure by whom, to a community of people who were interested in the sort of technology of it. So you could say it was a hobby. But it's now been embraced by people who are serious, by venture capitalists. They're not hobbyists, who are putting a lot of money into building an infrastructure around it. So we don't know for certain who Satoshi Nakamoto was or is. I think the leading candidate is Nick Szabo, who I mentioned earlier. But I kind of have a personal reason for wanting it to be Nick Szabo, which is that, why isn't this scrolling? Oh, here we go. Which is that he cited me once. So back in 1998, back in the old days, Nick Szabo was thinking about how to have a monetary system like a gold standard, where people could rely on it, not have to trust the government, not to debauch it, but without the cumbersomeness of gold. In a digital age, you don't want to carry around bags of gold. Okay, you can have digital claims on gold, but then you have to trust whoever runs the vault, and you have to trust the government not to nationalize the vault and then take away the redemption option. So that's what he was working on. His project was called BitGold, and it was for that reason, he was trying to emulate and improve upon the model of the gold standard. Oh, sorry. I hit the end button. Well, this is keeping me from going too fast. That's good. Okay. So there were many predecessors, or several predecessors. I mentioned already DigiCash, which was centered here. which came up with a cryptographic solution to the double spending problem, namely public-private key cryptography. And David Chaum was trying to get banks interested in adopting this, and they said, we don't see the advantage of making something that will allow people to transact without our participation. Why would we do that? But Wei Dai, Nick Szabo, and Hal Finney were working on ways to have a decentralized currency system without people double spending, that is, taking their file that represents their coin and just copying it, and now having two coins. And one of the items that went into that was proof of work. The original application of proof of work was to prevent email spam. Make the person sending you the email invest a penny or a tiny bit of computer time before the email goes through. So that won't stop your friends from emailing you, but it will stop a spammer who's trying to send out 1 million emails. And they saw that that could be a way of helping to solve the double spending problem. And so in the Nakamoto white paper, you can see bits of the predecessors, the B-Money and the BitGold and Hal Finney's random proof of work. And my suspicion is that there's some combination of these three guys, but the people have seriously analyzed the text of the white paper and said it reads like it was written by Nick Szabo. So maybe it was, even if he wasn't alone in solving the problem. Anyway, the first client is issued, the first bitcoins are generated, and now the problem is, what are they worth? So they don't have any link to a commodity to provide a basis for it, but in the mists of history, apparently the first recorded transaction was 10,000 bitcoins for 2 pizzas. I hope the pizza guy didn't spend them immediately, held on to them for a while. In 2011, it crossed $1, and that's when a graduate student brought it to my attention, sort of explained to our research seminar what Bitcoin was and kind of the rudiments of how it worked. I told him to publish that paper. He's kind of a slow worker. He would have been mobbed with interview requests if he had published that paper back then. But if you want to know today's value, it's kind of useless to put it on a slide because it's obsolete by the time the slide is shown. Don't hit end again. But here's the CoinMarketCap page from 2 days ago. And I've got some pertinent things circled. So the entire market is now worth 600 billion. And Bitcoin's dominance is down to 37.8%. Of course, when Bitcoin was the only cryptocurrency, it was 100%. For a long time, it was in the 90s. And then for a long time, it was in the 80s. But in the past year, we've had a proliferation of cryptocurrencies that the market is taking seriously. So that's sort of the new event. That's the important event of 2017. The diffusion of cryptocurrency value, broadening of the market. So I have some old slides from previous times I've given talks and just stuck them here so you can see the evolution in retrospect. So this is just a little low, about a year and 3 months ago. What did I say it was? 600 billion? Only 12 billion then. All right, so from 12 billion to 600 billion in 15 months, that's pretty incredible. And that, of course, is why there's so many headlines today. But even at that point, Bitcoin was 80% dominant. So compared to that, it's now 50 times larger. Bitcoin's grown only 24-fold, which is pretty good if you're holding Bitcoin, but right, only half as much growth is in the market, and that's why its market share has about been halved from 80% to 38%. And we've got new entries. So this is 2016. There's no Bitcoin Cash. It's now number 3. There wasn't any Cardano. There wasn't any IOTA. Go back even a little further. Now we're in ancient history. 2014, 5 billion in market cap, 4.4 billion in Bitcoin. So you see the growth between 2014 and 2016 was 2.3 times, which is impressive, but it's not 50 times. Now, it's hard to believe that 50 times growth is going to continue. I mean, people who've projected that say, in 2 years, Bitcoin mining will consume all the energy on the planet if it continues growing 50-fold. So there are limits, but the optimism of the past year is pretty clear that it's grown by leaps and bounds. The earliest screen cap I could get using the Internet Archive is May 2013, and at that point, Bitcoin was worth 1.2 billion, and the others were pretty small. Litecoin was 59 million, but beyond that, it was 5 million. You don't make the top 50 with a 5 million market cap these days. And as I said, Bitcoin was 94%. So when I used to give talks and try to give the audience a sense of how big Bitcoin was compared to the fiat currency of the world, Bitcoin was in the neighborhood of Croatia. There was as much Bitcoin in circulation as Croatian currency in circulation. It's a little different today. This is from an article published last month. Bitcoin now number 6 among the world's currencies. So this is comparing the monetary liabilities of the central banks of these countries. Slightly smaller than the Indian rupee, larger than the Russian ruble, larger than the pound sterling. So that's serious size. And not only Bitcoin, because we've seen the enormous growth of the other cryptocurrencies. We used to call them altcoins, but that seems a little pejorative these days. So Ethereum's in the top 20 of the world's currencies, and Bitcoin Cash has just edged in as number 20. So that makes it larger than the Swedish krona or the South African rand, Bitcoin Cash. Okay, so that you could learn anywhere. Let me try to talk some economics. What gives there are two models of private currency, redeemable and irredeemable, commodity-backed and not commodity-backed. What gives a redeemable currency value? It's a demandable debt. Anytime you want, you can come in and say, give me the silver coin, give me the gold coin. All right, so this one says redeemable in gold coin. We'll pay $100 in gold coin to the bearer on demand. So it's a contract. You can call for your gold coin at any time, and if you trust the issuer of the contract, then you value it at the amount of coin you get for it. All right, so that's pretty simple. You can call that a money-back guarantee system. If you don't trust it, you can get your coin back. If you do trust it, you value it at the value of the coin you could get for it. But what gives an irredeemable currency value? Well, Bitcoin works on a limited edition model. It guarantees the number of units in circulation, and now the market determines what the price per unit is. And this is an old model used for a long time in the art market. So Andy Warhol's factory, he called it a factory, and it was literally a factory, produced these prints, and what gives them value? You know, you pay $300 for one of these prints when it was issued, You know it doesn't cost them $300 to print another one. And this question was raised actually by the famous economist Ronald Coase back in the 1970s, although he never thought about it as being a model for a currency. So this is a sort of business problem for the issuer of the print. How do they get people to believe that the value is not going to go down by cheap prints appearing next week on one of those home shopping networks? Because it would be profitable once they sell out the limited edition to print new ones and sell them for, they've got everybody who's willing to pay $300, now we charge $200. And when we sold all those, we go to $100 and so on. But if the customers suspect that that's going to happen, they won't pay $300. So what guarantees that that won't happen? Well, it's not Andy Warhol's signature, because that's a fake. That's published on there. It's the limited edition. I don't know if you can see this in the back, but it says number 1630 out of 3,000. They're promising that they're not going to print more than 3,000. Even if the price goes up, they're not going to print anymore. Okay. So that makes it a possible investment. You don't have to worry about the value going down through hyper expansion of the quantity in circulation. So now I'm talking in kind of currency terms. And this is the Bitcoin model. You are promised, and the commitment is not just a pencil on a piece of paper. And this is actually kind of hard to enforce. I mean, you wouldn't know you'd been defrauded until you saw another number, 1630. Only then would you suspect that they were being duplicated, contrary to the promise to only issue 3,000. But in the case of Bitcoin, it's ironclad. It's in the program. It's publicly observable how many are in circulation. Yeah.
Can I pass you this? So
Yeah, hi. My name is Willem Karek. So the whole idea that especially I'm a bit older, but like the new money, they are a bit shocked with a rather high nominal price of an individual Bitcoin, so they all seem to go, Ripple is a great example, they go for the low values, and they don't, and then I come back to what you earlier said, the limited edition model. How do you, is it a temporary phenomenon, or will it over time, will the markets become efficient, or is there maybe also a different model of how to value those new coins?
So you're saying the money that's been pouring into the crypto market, say in South Korea, has been going to Ripple?
Yeah.
Okay, that's news to me. I mean, I'd heard that there was a lot of investment, but I didn't realize it was not distributed evenly. That I'm not. But even Ripple has a limited edition model. There are so many Ripples that they've all been pre-mined.
I think he's saying with a low price, like $2 a coin.
Yeah, so why you would want 1,000 coins at $2 rather than 2 coins at $1,000 each, that I don't understand. That doesn't really make any sense. Well, if anybody else has a suggestion, I don't know. I mean, what you care about is how the value you put in is going to grow over time, not about whether you have, I mean, it's kind of bizarre, right? Because if you're buying carpet, you don't care whether it's measured in square meters or square inches. You care about how much you pay per area. Yeah.
But on this same topic, we both said the same thing. There is a psychology involved. And that's why when you go to buy carpet, they'll try and put it in a unit that you can't figure out. Right? They sell carpet by the linear foot, let's say, but you have a square roof. So it's a psychology. It doesn't mean that it's right, but
Yeah.
it's explainable.
Did everybody hear the question?
I was just talking. I was responding. I was just saying there's a psychology to a $2 coin. Like, you know, you want to buy Berkshire Hathaway, it's 38,000 or whatever thousands. Oh, I can't even afford one share. So that's a psychology.
Yeah.
That's all I'm saying.
No, you're right. I mean, this is a common thing in the stock market. When the price gets too high per share, they will split the shares. And finance economists don't understand it. It's completely unexplained, except if you've got somebody who's so constrained they can only afford one share.
So since I have the box, can I ask
Yeah.
a question? What do you think about the impact of transactions costs on the value of the coins, given that you said that you're buying a payment system?
So it has to be discouraging if you think that the future of Bitcoin is as an everyday retail payment mechanism. Something's got to be done about the congestion, about the high fees and the high wait times. Now, even at its design, the promise of Bitcoin was to validate transactions in 10 minutes, which means it's not going to be Visa, it's not going to be MasterCard, because you don't want to wait at Starbucks 10 minutes before you get your coffee. So that was already known. But it does, and it's, even if it's a day or a day and a half, it might not matter for some kinds of transactions. But if you're talking about, I don't know, buying stock, the difference between a day and a half and 10 minutes does matter. So if there's a way to speed up the process, well, of course, that's what the fork between Bitcoin and Bitcoin Cash was about, speeding up the transactions process. A coin that does everything else that Bitcoin does but is faster has an advantage. Of course, it's not Bitcoin anymore. Now it has its own blockchain. So it's not going to be exactly Bitcoin with all the infrastructure around Bitcoin. But what we're seeing is a competition among different models of the trade-off between security and transaction speed. And we all have to sort of wait and see whether technological fixes, side chains, and the Lightning Network and so on are going to solve the problem for Bitcoin, or whether it's going to be another coin that solves the problem by using a different means.
Hi. Acquisition power doesn't really come back in the story when we talk about how money actually works as a fiat currency, etc. I can imagine that if there's no stability in value, even if transactions can take place very fast, if you try to store a certain amount of Bitcoin or another cryptocurrency, knowing that you're planning to buy something in a month, it also sort of loses its comparison value.
Yes.
And from a behavioral economist standpoint, you could say, I feel that volatility also creates something it's probably a question of time until one comes out victorious or a certain stability does happen.
No, I agree with you. So there are three obstacles. One is the advantage of the incumbent in having the dollar or the euro, in having already a big network. There's a network effect to using a currency. You want to have the most potential trading partners, so you want money that has a big network. Second is the congestion on the blockchain, and third is the volatility of value. It makes it a dangerous way to hold your paycheck. Sorry, your rent check, your rent money.
Just more to speculate, like many is a cliché, but at the moment it doesn't feel like anything else needs to speculate.
So it makes the fact that most of the volatility is in the upward direction makes it a happy savings medium or an investment with a certain degree of risk over any finite horizon, but doesn't make it an attractive transaction medium. You're absolutely right. So that provides an opportunity for different models, like coins that promise a stable value in a fiat money. That's the Tether idea, or BitShares USD. Or, and this is something that I would like to see, and there are people working on it, a currency that is linked to the value of a basket of goods. So it has a purchasing power even more stable than a low inflation fiat currency. That would be an attractive transaction medium. It's not the traditional form of money in the sense that it's not physically composed of a material and it's not redeemable at a fixed price, but it's programmed in some way to keep the value stable. So,
I trust, right? But you also need trust to be able to keep value stable if there's a little bit of
but trust is important, but there are two ways to gain the trust. One is to have people in charge who have a good track record so far, but the other is to have a program that is public. The source code is out there, the workings of the system can be examined by anybody who takes the time to do it. So there's been a long debate among economists about putting rules on central banks, but Bitcoin has the hardest rule we've ever seen, in the sense that it can't be, there's the 51% problem we all know about, but it can't be just a few people in a room deciding to change the monetary system. The way is a danger with fiat money. Sure.
Maybe if I could have your opinion about the number 2 coin at the moment, that's Ripple.
Right.
Everybody is talking about it being decentralized now, how it's changed. Have you heard about this? About the bank actually using the currency as a, alternative to their fiat currency.
No, I'm not quite sure what you're saying.
Decentralization of the Ripple coin.
How is it being decentralized? It's still,
Because it's being used by the bank right now.
I mean, it's still run by Ripple Labs, right? Now they claim the coins are all pre-mined and they're a blockchain. It's not exactly a blockchain, but their program, their source code is observable as well, and there's a consensus mechanism that's supposed to be transparent.
So all the Ripple coins have already been mined?
Yeah, but we don't know exactly how many are still owned by the founders.
By the actual founders, they hold all the coins. So because it has such a maximum circulating supply, as opposed to the infinite amount of Bitcoin, do you think it has more potential to be?
Oh, Bitcoin has a ceiling of 21 million units.
Yes, exactly.
And Ripple has a ceiling of what's currently been mined. They claim aren't going to be any more.
100 billion.
So,
There's one guy at Ripple. They've got a kind of freeze protocol. If he doesn't like you, and he thinks you don't deserve your fee today in Ripples, you can just push on a button and lock your account. That's how decentralized Ripple is.
well, that's not going to promote trust.
No, of course not. That's the whole joke about it. There is currently also momentum investors like volatility. Volatility pays off. So there are a lot of factors going on.
Well, I think what you're saying helps explain why there haven't been more for-profit cryptos on the Ripple model. And I was surprised by that. I thought, oh, the venture capital is moving in. The rest of them are going to be done as for-profit corporations. But it's not true. Many of the new coins, IOTA, for example, are done by foundations in order to take away the problem of suspicion of the few people are profiting from the whole project, that they somehow have an incentive to control it in an unhealthy way. So,
one more question.
Yeah.
You mentioned that the price is established by the demand and supply, but how does the futures of Bitcoin that recently launched in Simi Group, how would that change?
Say that again. How would what?
SME Group recently launched the Bitcoin futures.
Okay. Yeah.
For big guys.
The Chicago Mercantile Exchange. Yeah.
So does this change the model of the price?
Well, it enables people who are, for a long time, lots of economists have been saying it's a bubble, and now we can say to them, put your money where your mouth is. Go short it if you really think it's a bubble. And yet, when they opened the futures exchange, didn't make the price come crashing down. Turns out there weren't that many people willing to put their money where their mouth is when they said it's due to crash soon. So it doesn't seem to have made any spectacular difference. It corresponded with the price actually going up a bit. But it enables people to speculate on the price without actually buying Bitcoin. But what they're speculating on is other people buying Bitcoin. So, yeah, it doesn't really change the fundamental model any more than having futures in onions changes the supply and demand for onions. Or futures for currencies.
Maybe this is really basic, but all this craze about cryptocurrency seems to be with the basic idea that decentralization is good. I mean, as an economist, I would like to have your opinion of why is decentralization good when everything else that is important for us is centralized with the government. If government is good enough to govern us, why can't they control the currency where we put our value in?
Yeah, so I'm not in favor of decentralization of everything, and I'm not in favor of centralization of everything. I'm in favor of letting the market sort out what should be centralized and what should be decentralized. There's not one template that fits every good and service. And one of the questions I have about the idea of Bitcoin serving as a clearing mechanism for sidechain transactions is that traditionally clearinghouses have been centralized. And before governments took over, the banks would get together and form a club, but there was one club in any city of all the respectable banks. And they owned it, and so it didn't exploit them, it didn't act like a monopolist, but it provided services just for its members. It didn't interact with the public. But that's a case of spontaneous centralization driven by the efficiencies, not driven by any sort of political motive. And so it's not clear why you would want a decentralized payment mechanism to replace that. Worked perfectly well. It's advantageous to have it be private rather than be publicly owned as long as it's central. Owning it as a co-op means that there are certain, it's not going to be a monopoly that exploits its customers. But in the case of money, we have lots of historical evidence from the era of private banknotes, redeemable private banknotes, that decentralization works just fine. Adam Smith wrote about this in 1776. He said, look, the more banks you have, the better, because they have to compete to make loans that'll bring interest rates on loans down. They have to compete to attract deposits that'll bring interest rates on deposits up. And so the spreads between those two rates will be as small as possible. And the failure of any one bank is of less consequence the more banks you have. Each bank has a smaller market share, no big deal. In the case of cryptocurrencies, as I mentioned, there's a network effect in the monetary unit. You want to be paid in a unit that you can turn around and spend. And so it's hard to imagine that it's kind of a winner-take-all market in any particular economy. We do have more than one currency in the world, right? But often that's because of legal obstacles to adopting the better currency from the country next door. And so it's hard to imagine dozens of different cryptocurrencies all being accepted by the retail grocer on the corner. Not impossible. I mean, if it's cheap enough to interchange them, and he can immediately get out of the coins he doesn't want and into the coins he does want. It's like having a plug adapter makes it easy for me to come here and use the electricity. It's not a big deal that the plugs aren't the same shape. But those kind of balances of costs and benefits are something that has to be worked out practically. But you're perfectly right. There's no one-size-fits-all case for centralization or for decentralization. So in the case of money, I think there's a natural convergence, I would call it, rather than centralization, on a common unit, but you can have lots of issuers of money denominated in those units. To the extent that cryptocurrency is going to be used as a retail payment mechanism, Bitcoin is the leading candidate. Everything else is pretty far behind. But the business case for other cryptocurrencies doesn't depend on them being used as retail media of exchange, right? The case for Ethereum is that it's a platform for smart contracts. And the case for IOTA is that it's the platform for the Internet of Things, and so on. The case for Dash is that it provides more privacy as long as the government lets it. What I've done here is take the recent list and just tell you what these other features being provided by non-Bitcoin cryptos is. And the winged foot means these are all faster at processing transactions. The stack represents these are platforms for smart contracts, and the cloaked spy figure indicates that Dash is sticking its neck out and saying, we provide more privacy, more anonymity to our users by cloaking transactions. And I say that's a risky strategy because governments don't like that. Shall I continue? Okay.
What do the stars mean?
Oh, the star means that it's private. It's for profit. It's closely held. So I don't think I'll go into the mechanics of Ripple, but Ripple's business proposition is to work with banks at processing remittances, because the legacy clearinghouse systems for making payments internationally are pretty cumbersome. You have to go to your bank has to go to the central bank, that central bank has to communicate to a central bank in another country, and then they have to communicate with a retail bank in the other country. It's slow and it's cumbersome, and Ripple's going to speed things up. I should say that in the market for remittances, there is an obstacle to using a cryptocurrency, which is it adds an additional exchange transaction. If I'm trying to send money to the Philippines, I can send dollars and then they can be exchanged for Philippine pesos at the receiving end. That's one foreign exchange transaction. If I take dollars and buy Bitcoin and then send Bitcoin, then the Bitcoin has to be exchanged for Philippine pesos. That's two foreign exchange transactions. Now, if the sending is sufficiently cheaper, it still works. But Western Union and MoneyGram have been pressured already, and not just by cryptocurrencies, but by internet services like Zoom. And their fees have come way down. They don't charge 10% anymore. They're down to 3% in most thick markets where they're facing competition. You know about Ethereum. You know about Bitcoin Cash. You know about IOTA. You might not know about cannabis coin. My coming to Amsterdam had nothing to do with marijuana, but in the United States, there are jurisdictions in which the state government has said recreational marijuana use is okay. And there are pot dealers who are legal under state law, but they're still not legal under federal law. So this has to be hashed out, no pun intended. This has to be resolved somehow in the court system. But for now, the legal pot dealers are not allowed by the federal government, this was an Obama administration initiative, are not allowed to have bank accounts. So they cannot be paid by credit card or check or deposit transfer. They have to take cash. And it's a big hassle for them to deliver a big to have a big bundle of cash, which they then have to store in a vault somewhere. And then what do they do with it? They can't deposit it in a bank because they're not allowed to have a bank account. And so these coin projects are hoping to provide an alternative means of payment for these shops so that they can take electronic payment and not have big bags of cash to worry about. So far, none of them's really caught on, but it's a nice idea. So here's the history of Bitcoin. I'm sure you've all seen this. It looks pretty dramatic. If you put it on a logarithmic scale, it's still dramatic, but it's not quite that dramatic. Right? So Bitcoin's been rising in percentage terms for a while. You can see the slope has gotten steeper. That means it's rising faster in percentage terms. Its growth rate of value has gone up. So the two lines are the price per coin and the total market cap, and the difference between them represents the slightly growing number of coins in circulation. But I've put a series of columns under it to suggest that this seems pretty well supported. By contrast, there have been cryptocurrencies that I call bubble coins that were once worth something and then lost their value. And the kind of process of driving up the value has been known as pumping and dumping. And if everybody dumps, then the value goes away. The problem with these coins is they didn't really do anything different. And so there was no reason to think they were going to take over from Bitcoin. So we had Frycoin, we had Megacoin, we had Terracoin, came crashing to earth appropriately. We had Barbecue Coin. You have to admire the name, I guess. And, whoops, darn it. What would you expect from Mooncoin, right? There we go. It had a brief moment in the sun and then disappeared. But we don't see that pattern in Bitcoin. That's the point I'm trying to make. So here's some silly things that economists have said. And most economists refuse to talk about Bitcoin. I gave a talk in New York at something called the Blockchain Economic Forum. And after I spoke, a couple of reporters came up to me and said, "Are you willing to answer questions about Bitcoin?" I said, "Sure." Oh, none of the other economists we talked to will. So can I call you if there's a news story? Yeah, sure. Great. So you have to admire Francois Veld from the Chicago Fed for being willing to write about Bitcoin. And back in 2013, he noticed it was something. So I'll give him credit for that. He calls it a quasi-monopoly by virtue of its first mover status. If all he means is that it had a big market share, sure. But it's not a monopoly in the sense that economists worry about monopoly, in the sense of being able to restrict output and thereby get a higher price, because the number of bitcoins can't be restricted. It's on a program. The number of cryptocurrencies can't be restricted by Bitcoin. Entry is open. You can introduce an improved version of a cryptocurrency, and the market share has fallen from 94% to 38%. But my favorite part of Veld's article is this, sort of giving a dire prediction as to the future of Bitcoin in 2013. It's hard to imagine a world where the main currency is based on an extremely complex code understood by only a few and controlled by even fewer, I guess he means the miners, without accountability, arbitration, or recourse. If you can take out the words complex code and put in bureaucracy, he just described central banks. And yet we have a world where central banks control the main currency, even though what they do is understood by only a few and controlled by even fewer, without accountability, arbitration, or recourse. A little bit of irony there. Here's Brad DeLong, sort of making the opposite worry. Not that Bitcoin's a monopoly, but that there are too many competitors. Unless Bitcoin can differentiate itself, the money supply of Bitcoin-like things is infinite, implying that the price has got to go to zero as it gets duplicated. So he's thinking of a world in which, say, everybody had the right to counterfeit the US dollar. The value of the dollar would quickly go to the price of the paper and ink. Yeah, but Bitcoin's not like that. You can't just go and, you can create a new coin, but it's not Bitcoin. It doesn't share the Bitcoin blockchain. It has a blockchain that nobody's using. So it's not the same thing. It's like saying that when Zimbabwe decided to call their currency unit the dollar, that was going to erode the value of the US dollar. No, when the Zimbabwe dollar hyperinflated, it wasn't the supply of dollar-like things that we need to be concerned about. The exchange value of the Zimbabwe dollar went to zero, not the US dollar. And to talk about the cost of production of Bitcoin is a mistake. And I see this in journalists all the time. They say, oh, well, the value of Bitcoin is regulated by how much electricity it takes to produce it. No, the electricity doesn't produce it. The number of Bitcoins is already determined. If everybody decided to use less electricity, or if the electricity became cheaper somehow, wouldn't affect the supply of Bitcoin. So John Cochrane, who's an interesting economist, and I have a lot of respect for, had a piece on Bitcoin a month and a half ago. And he says it's not a bubble. It's rational for people to own Bitcoin because it does something for them. And he describes it as avoiding both the beneficial and destructive attempts of governments to control economic activity and to grab wealth. In other words, tax avoidance. I won't say evasion because that's a legal term. But he says it's not a very good money because it has huge price fluctuations, which I think he's right about. That is an obstacle to wider acceptance of it. But here's the mistake. It's an electronic version of gold, and the price variation should be a warning to economists who long for a return to gold. I mean, that's just silly. It's not an electronic version of gold. The supply mechanism is very different. And if you wanted to know whether gold was unreliable as a money, look at the history of the gold standard. Don't look at the price fluctuations of Bitcoin or even at the price fluctuations of gold since it was demonetized. Look at the behavior of gold when it was a money. The more widely Bitcoin becomes accepted as a money, the more people hold it as a transactions medium, the more stable the demand will be and the less volatile the price will be. But it's kind of a chicken and egg problem. People are reluctant to hold transaction balances in it as long as the price is volatile.
Professor White?
Yeah.
What needs to happen before the volatility of Bitcoin could conceivably go down? Is it, you're referring to the market cap? Does it have to be a certain level?
No, I mean, what I'm thinking is there have to be demands for the use of Bitcoin in transactions so that the fewer of the demanders are people who are trying to take advantage of trends. Right? If people are buying and selling Bitcoin based on it going up for a few days or going down for a few days, that amplifies the volatility. There has to be more what you might call normal use of it. And the same thing happens to gold today. People buy gold as a way of speculating against the fiat currencies. And so the price is driven by rumors and intelligence about what's going to happen to the fiat currencies.
So
It's also happening to Bitcoin.
Are you then saying that there's no correlation between market cap and normal use?
I think the market cap reflects the anticipation of future use. I think it's got to do that, but not the day-to-day movements. So I think if we don't worry about the volatility from week to week, but look at the trend over years, you see growing optimism about the business case for Bitcoin. I don't think that can all be just people chasing the value up. Like the comparison is often made, as I'm sure you know here, to tulip mania. Turns out people who have examined the history of the tulip prices say it wasn't actually a mania until maybe the very end. But back to Bitcoin. There are people, right, riding the wave who don't know anything about it other than the prices going up. But that's not the sort of fundamental driver, I don't think. I think the rise has been too large and too steady for that.
Can I ask a follow-up?
Now, the people who are optimistic about its business use may or may not be correct. Yeah.
You just covered the slide on electricity consumption as part of the proof of work
Right.
discussion. Can you talk about where that might go? Is that just a consensus decision? I mean, where might that go? Because it's a point of criticism. It can't be a point of regulation necessarily, but
Yeah.
where do you think it might go?
Well, it's kind of a fundamental principle that people will expend cost in anticipation of a return, and at a high price per Bitcoin, more electricity will be readily expended for a given chance of being the winner of the validation lottery until the probability is driven down, and that's what will equate at the margin. So I don't see a way out of the high cost of processing. There's kind of an arms race built into the architecture of Bitcoin. If somebody can convince me I'm wrong, I'd be happy, but that's the way I see it. As long as, right, the price times the probability of being the winning validator is high, people will spend the electricity to get into that lottery.
Unless there's a consensus that they have to change.
Unless there's a change to a different consensus mechanism, that's right.
For Bitcoin to be accepted as retail payment device,
Oh.
Yeah. Yeah. Okay. Yeah. Now it's better.
So for Bitcoin to be accepted as a retail payment device, eventually a part of it, the cut should go to the government. Government should start accepting payments, taxes, VATs, whatever. So unless the government put their approval on it, then the way I see it at least is that it's very difficult for it to become retail payment device, right? Or is there a wrong assumption?
I don't think acceptance for tax payments is that important. And I say that because when I look at spontaneous dollarization examples, that was the last thing to happen. In Ecuador in 1999, the local currency, the sucre, was going through a terrible inflation. Everybody dollarized themselves until the only people using sucres were the public employees who were paid in them, who would immediately cash their paycheck for US dollars. And the day before taxes were due, people had to convert into into sucres, but nobody wanted to hold sucres other than that day. So you could have a much wider acceptance of Bitcoin without the government accepting it.
And also going back to your tomato soup example of Andy Warhol, you mentioned you had compared that to Bitcoin, saying it's like limited edition version. So,
yeah.
But nobody were thinking when they bought that tomato soup printout to use that as retail payment. So it was collector's edition to hang it on the wall, maybe.
That's right.
So if we compare Bitcoin to that, then are we saying Bitcoin is a collector's item? Then will you be able to use it for retail payments?
So for some people that may be true, that it's the people who spell hold incorrectly. And I said some of the very early adopters seem to say that. I don't care if it's good for use for anything. I just want to make an ideological statement by telling people I own this non-government currency. But I don't think much of the growth can be explained by that. I don't think there's been a mass conversion to admiring Bitcoin for its own sake. It's people who either want to make transactions, who are anticipating other people wanting to make transactions, or some other fundamental reason for holding Bitcoin. Okay. Okay, so I guess I've already said this. It's different from what Hayek imagined of stable, valued, privately issued money where there's a promise to keep the purchasing power stable. But there is the possibility, I think, of a stable coin that would guarantee, would be programmed to produce a value that's stable in terms of some index. Now there is a conceptual problem here, which is the Bitcoin program is self-referential. The rate at which Bitcoins is issued refers only to how many have been issued so far. So it doesn't have any input from the outside world. There isn't any feedback. To stabilize a basket of commodities, there has to be some kind of feedback mechanism, which means some way of taking information from the rest of the world. And how to automatize that in an incorruptible way, that's a real problem. The way Tether, to the extent that you believe it, the way that Tether promised to keep its value stable in terms of US dollars is by having a dollar-denominated bank account and promising to convert back and forth whenever you want it. They've had some problems because their bank accounts have been kicked out of the banks that were holding them. The American bank, Wells Fargo, which used to process their wire transfers, won't do it anymore. There's never been an announcement as to why Wells Fargo made this decision, but I suspect the US Treasury behind it. So anyway, you have to trust the people running Tether to maintain that promise. It's not in any kind of program. BitShares USD has a different mechanism, which I don't really understand. The descriptions of it are very complicated and convoluted. But anyway, that could bring us a cryptocurrency which is more like what Hayek imagined. But the real problem with Hayek's model was that he didn't consider the possibility that as long as the money is positively valued and there's no constraint on the quantity, then the issuer always makes a bigger profit by issuing more of it. As long as the value is greater than the cost of producing another unit, produce another unit. I don't think he really solved that problem. Bitcoin has the potential problem of somebody hijacking the system, but the incentives don't work in that direction. The miners understand that nobody's going to want it if it's seen as hijackable. And so the mining pools have actually avoided reaching such large size that they can easily collude. So people who predict that Bitcoin was going to fail because of a 51% attack problem have been wrong all along. The way somebody put it was that it's backed by game theory. Now, here's a problem that is kind of in the background of the congestion problem. I said that some people, in response to the problem of using it for retail transactions, have said, well, it can serve as the clearing mechanism or the clearing medium. So back before central banks, there were private clearing houses owned by their members, and they settled on a common ledger, a private gated ledger, not an open ledger. And that works perfectly well. And we have models of that today in the foreign exchange market. CLS Bank, which is short for Continuous Linked Settlement, is owned by 69 of the largest banks in the world who do a lot of foreign exchange trading. And so no one or two of those banks can hijack it, and it's not going to itself serve as a monopolist and exploit the members because the members together own it. That kind of system scales pretty well. All you have to do is add more lines to the common balance sheet. This graphic makes the balance sheet look like an Excel graph, which it shouldn't. It should look like a T account with assets and liabilities. But anyway, it scales pretty easily. But when you settle on a distributed ledger, I mean, there's a certain genius to this because it makes the system secure, but it doesn't scale well. Here's my attempt to picture what it looks like. Every transaction has to be not just kept in one place, but in thousands of places. And so it gets congested pretty easily. And in a sense, by design, right? Because as Nick Szabo put it a few months ago, Bitcoin was designed to make trustless transfers between strangers, but to do that, it has a great deal of redundancy built into it. He described it a dreadful reduction in computational efficiency and scalability. You can't pay for coffee. Hal Finney was saying this back in 2010, just based on the 10-minute validation time versus instant with, nearly instant with Visa and MasterCard. But people are working on this problem, different kinds of distributed ledger technologies that don't have this kind of congestion problem. Retrofitting one of those to Bitcoin raises the issue of, will all the miners agree to it, or will you have another fork? But other cryptocurrencies, like IOTA, have different kinds of distributed ledger validation, which have less of a congestion problem. The problem they've got is attaining a critical mass when all the action is currently in Bitcoin. But we see Bitcoin's market share shrinking, so it's possible that at the end of the day, some other cryptocurrency will become bigger than Bitcoin. I mean, it's possible. So people have talked about moving transactions off the blockchain into side chains and then settling on the blockchain. But settlement mechanisms are typically among a small number of parties who know each other, which is not what Bitcoin is for. It's for real-time settlement between strangers. So it seems to me it's useful for, say, over-the-counter financial transactions, but not for bank or quasi-bank clearing, like I just said. I mentioned earlier that blockchains, not Bitcoin, but other blockchains, sometimes proprietary blockchains, are being linked to asset tokenization. So you have a numbered gold bar, you put it in a vault that participates in the system, they create a crypto token which trades on a blockchain so that ownership of the gold can change hands in a very easy way and an easily validated way that you are now the valid owner of this gold, not the guy who used to own it. That could reintroduce gold-denominated banking. So that would make my dissertation relevant, finally. But there is a challenge, which is you have to trust the vault keeper. Is there a way that we can improve the trustworthiness of the vault keeper? And quoting Szabo again, in that kind of system, we rely both on blockchain and on what he calls traditional financial controls and bureaucracy. That is, ways of making sure nobody at the bank is filching the money. Because the blockchain that says, here's the gold and who owns it, has to be true in order to be trustworthy, and blockchains don't guarantee truth. They just preserve truth if it's true to begin with. Preserve it from alteration. So I think we've covered most of the issues I was going to end with. So I think I'll end there, unless there are any other questions.
Yeah, I think we already had quite a few questions. Let's get just a couple more questions, because it looks like also some people might be ready for a break. So one in the back of the room. Yep.
It's so cute that you use a little block.
Thank you very much.
Okay.
Yeah, I'm Robert, by the way. Thank you for the talk, Lawrence. I have a question. Do you think that the current low valuation of risk, so risk is not seen as a big problem, the fixed index is very low, also helps the migration of fiat currencies, or the underlying value of fiat currencies, being drawn into a space where, okay, there is a lot of risk, but it's not being valued, and the reward that you get is quite substantially larger than that you would get when you would get something in a USD currency, for example?
I'm not sure I'm following what you're saying about risk. So yeah, compared to owning treasury bills, owning a cryptocurrency is riskier.
Yes, but you don't matter because you don't value the risk. So you naturally tend to go to the most risky asset class to get the biggest reward.
So who doesn't value the risk? I mean, a lot of people, a lot of big money has stayed on the sidelines because it's too risky to touch, they think.
But you see, it's maturing. You see that there are methods, liquid methods of transferring large amounts of market caps. So you know that you have a liquid asset class that has higher rewards than you would get in your normal quantitative easing environment that you are in currently. So you naturally tend to go to that higher rewarding asset class.
Yeah, so I don't think 2017 can be described as a continuous equilibrium. But in a financial equilibrium, if you've got a class of assets that is more volatile, it will pay a higher rate of return on average to get people to hold it. That has to be true. And so in some kind of long run equilibrium in cryptocurrency, the same thing would have to be true. I think the appreciation in 2017 was unexpected. I know if I had expected it, I would have behaved differently.
We'll do one more question, and then there'll be time during the break to talk individually as well.
Thank you.
My name is Olivier. People pay big bucks to buy casino tokens, right?
Yeah.
So they're just pieces of plastic, really. And so what do they get for it? Well, the excitement of losing them all or winning, right? And so
Yeah.
I was just suggesting maybe that explains part of the demand for the Bitcoins.
That could be. And some people buy stocks for the same kind of reason. They, look at what the stock has done each day and get excited about that. It's a little different from a casino, though, in that casinos, most of the patrons invest pretty small stakes. Well, actually, I don't know what the average holding of Bitcoin in dollar or euro terms is compared to the average amount people fritter away at casinos. But the casino sort of is entertainment. It takes place, for most people, it takes place in front of them. They see the wheel going around or the dice spinning or whatever. And so it's a harmless way to spend the evening. And the expected value, of course, is you lose money to the house. But it sort of doesn't, people typically don't gamble so much as to change their lifetime path of consumption, is the way an economist would put it. And that's true probably for most small Bitcoin investors. And the ones who are investing a lot, like the people who are making a living at gambling, know more about it, have some information that the average investor doesn't have, which gives them a little better assurance than continually losing to the house. So you have different classes of investors in response to the volatility of the market. And it certainly may be true that some people are attracted by just the spectacle of it all. But that may be true, as I said, in the stock market too. We don't normally think of it as being what drives stocks to any extent other than, hour by hour, but not month by month.
Okay, I think with that, we've really had an extremely interesting discussion and also very informative sessions. So,
Okay.
Thank you very much, Professor White.
Thank all of you.